Wow, what a day. I told you it would be. I said, do not buy into the rally that we saw most recently because you know what? The pain is not over yet. It will be eventually, but it's going to be a while between now and then. And we're hearing some rather alarming things about what the Fed may have to do next week, which I want to get into with you here today. This is a special edition of the Trish Regan Show. We're going to cover this whole issue in depth with my friend Carol Roth. She likes to call herself a reformed investment banker. I like that. Anyway, she spent many years in the financial industry, and she's got a lot of thoughts on this that we can go through. So look forward to that coming up. But before we do that, first of all, gold way up today. Rather appropriate time for me to plug our show sponsor, Legacy Precious Metals. Look, gold is one of those things that tends to help you when there's a lot of volatility, because the thinking is when things get scary, people do migrate to something like gold. So you're seeing gold prices up above 1,900 right now, which is good news for gold investors. I happen to be a long-term gold investor. It's up about 0.5%, $1,920, $1,920 an ounce. Legacy Precious Metals, that's the company that you should check out, legacypminvestments.com, if you're interested in investing in precious metals, gold or silver. So again, on a day like today, I think it's pretty helpful to keep that in mind. Again, long term, I think it's one of those things that can benefit a lot of people. Anyway, turning to the markets, this was just a miserable day, but you know what? It looks like we're ending here off the session lows, so one could be encouraged by that. What I am most discouraged by, disheartened by, and disturbed by is that the Federal Reserve is not going to be able to move as it had intended on interest rates when it meets next week. So the expectation before all HELL broke loose on Friday, the expectation was that the Federal Reserve was going to raise rates by 0.5 point. That's a lot, but let's face it, these guys were asleep at the switch for so long. I blame them for creating the entire mess we find ourselves in today because they left rates for too long at zero. And then when it finally came time to creep them up, it took them forever. I mean, they were still printing way too far into this. And then simultaneously, you had the Biden administration with their multiple stimulus plans. Oh, and don't forget, there was a third stimulus check. As soon as he came to office, he's like, whoopee, handing out money. That was such a mistake. You had both fiscal and monetary policy working together to pump as much as they could into the system. We have so many dollars floating out there. So something like this was bound to happen. At some point, as I've been warning about for now, 2 years with all of you? I hope you've been listening. Clearly, the folks over at Silicon Valley Bank were not listening to this podcast. If they had, they would have known that inflation would be here and that you would have higher rates and that there would be consequences associated with that. Well, they weren't listening. They just drank the Kool-Aid. All their friends there, like Powell and Yellen and Biden, this was a lot of people with groupthink that thought somehow that the Fed would be able to manage this. Come on. I'm looking when inflation, I predicted double-digit inflation, which we did see on the producer price index. But at one point, we were up at 9.6% on consumer prices. That is a lot. I mean, people are hurting because wages have not gone up the way the price on everything else has. Everything's gotten more expensive. And as I've explained before, once this stuff starts to take root, it's very, very hard to stop. The train has left the station, so to speak. So inflation's here. We got the number yesterday showing consumer prices up 6% from where they were last year. So we've got problems. The Fed has to fix this. But when they try and fix it, look what unfolds. And so now they're frightened. Can they fix inflation while simultaneously avoiding a massive bank failure of epic proportions that could have a disastrous effect on the economy for years to come? This is why they did what they did on Sunday night, because had they not, believe me, none of us would have been able to get any of our money out of the bank. It actually would have been really, really bad. But could it still get bad? I mean, these are the questions that we're sort of debating right now. It feels as though the system has been, at least temporarily, nationalized. You have the Fed saying to any bank out there, hey, you guys having a problem? Come to us. We'll give you a loan. Now, many of these banks have treasuries, so it's good collateral, assuming we don't default on our debt. And so that can kind of work. It's another Band-Aid. I do believe that after 2008, we took some appropriate measures to shore up our banking system, at least for the big banks, right? There were some changes along the way that left the regionals with a lot more wiggle room, which is why we're seeing some of these challenges. But the big banks had a lot of things that were put in place to really stress them and make sure that in the event of a real problem, they would still be able to function. The Europeans, however, they were not as vigilant. And I remember talking to a lot of European bankers way back in, I guess this would have been 2010, right? Because first it was the debt crisis here, the subprime crisis and Lehman Brothers going under. You had Bear Stearns. Don't forget, we're coming up on the anniversary of Bear Stearns getting sold for $2 a share. And then months later, that fall, you had Lehman go under. So we made a lot of changes to the system. And then a couple years after that, you had the European debt crisis. Well, most European bankers I know say it was nothing but a bunch more Band-Aids, and it wasn't actually anything that was worthwhile enough to fix the underlying problem. So they still felt like banks were vulnerable, and that's what you're seeing reflected today. Look, Credit Suisse is very different than anything that's been happening here in the U.S. Credit Suisse had a whole host of issues and scandals, and Deutsche Bank also is now coming under fire as a result of that. So keep an eye on those stocks. As for regionals, I suspect a lot of them are going to get bought by the big guys, which is a problem for us, right? For you, because look, I mean, banking fees are high enough as they are. When you start whittling it down and you get rid of all the regionals and they get scooped up by the big guys, well, then the big guys, they have all the power. And so they therefore can charge you so much more in terms of fees. So it's not really advantageous for the consumer to have that, nor is it advantageous for the consumer to have their bank go out of business. Pick your poison here. This is a tough time. I think the markets are going to be just miserable this year. I mean, for those that have a very long time horizon, you might be looking at whether or not there are any bargains out there. Don't forget, when there's all this fear, and that's what this is right now. Because frankly, the economy, it's not great. Like, it's not. We know that, right? It's not great, but it's also not awful. I mean, I don't love it. We're not growing the way we should, but it's not like it's hemorrhaging. So this comes down in some ways to confidence, at least as far as the U.S. banks go. So when that confidence gets rattled, it's like, inflation leaving the station. So much of this is based on human psyche. If you think something's going up in price next month, you buy it this month because you think you'll get a better deal. And so you keep buying for fear that it's going to go up next. I mean, deflation, of course, is also very hard to fight because when you think the price is going down next month, you don't bother purchasing anything because you think you can get a better deal down the road. It's complicated stuff. The Federal Reserve has overcomplicated it by frankly being far too simplistic and just thinking that, we haven't had inflation in years and years and years. It hasn't happened in decades. So why would it happen now? Well, guys, this is the law of unintended consequences. You've got to be prepared. Here with me to break down the insanity of the last couple of days and what probably is going to continue to be a lot more insanity on the way, we have today Carol Roth. She is a reformed investment banker. I love that title, Carol. A reformed banker. And she's an author. She's got a brand new book coming out. You can pre-order it today. You Will Own Nothing is the title. Carol, welcome to the program. Great to have somebody from the financial industry to kind of help us figure out just exactly what happened and what's going to happen. Welcome.
Thank you so much. I don't know if you're a big fan of the 70s movie Airplane, but they had that whole running gag. I picked the wrong week to, quit sniffing glue. I picked the wrong week to quit sniffing glue, Trish. I feel that way.
You wish you were still in banking?
What?
Oh,
No,
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 no.
not to quit banking, just the glue part.
Got it. Anyway, yeah, it's a crazy week. We've got a ton of volatility. You look at the market right now, and things are pretty challenging out there. I said, as we saw some upside the other day, don't count on it, only because more pain was likely to come. People are realizing that there's no way out. The Fed, what the heck is it going to do? It wants to raise rates to control inflation. We got a lot of inflation. Now, apparently it can't, because we got a banking crisis on our hands. Currently, as we go to air, Carol, I'm looking at a market that's off about 650 points there on the Dow. Not a whole lot of places to hide. Everybody's jumping from bank to bank. Now they're worried about Credit Suisse. Let's take a step back. We'll get to Credit Suisse in a second. But what exactly happened with Silicon Valley Bank, with Signature Bank, some of the other big regionals, First Republic? What is this fear factor? And is it contained by way of what the Fed did?
Yeah, the way I like to break it down, particularly for Silicon Valley Bank, is that I feel like the Fed was the arsonist that burnt the house down, and then they wanted to stand by with a bucket of water and throw it on the house and go, "Oh, look, we're helping to put out the fire." So, this all goes back to the fact that we have had easy money policy. Basically for the last 15 years, we got a little bit of a move towards raising interest rates and a theoretical pause on QE. And then COVID came about and we had quote unquote emergency policy, stimulated the economy, printed trillions of dollars. And there was all of this money intentionally sloshing around the economy. So in Silicon Valley, that meant a lot of funding for startups. And they went, and because of different deals that are made out in Silicon Valley, a lot of them put their deposits with Silicon Valley Bank, which normally for a bank is a great thing to do. But after 15 years of easy money, they didn't have enough people to lend to. So they had more deposits coming in, but they couldn't put that money to work the way that a bank usually does, through making loans. So they said, okay, well, we have to do something with this money. We want to try and get some yield. And here's where the really weird boneheaded management thing happened, is they decided to put that into quote unquote safe securities, treasury, mortgage-backed securities, but lock them up not for 6 months or a year or even 5 years. They locked them up for 10 years.
I know.
Which makes no sense, because the head of Silicon Valley Bank sits on or used to sit on the San Francisco Fed. So the idea that the Fed was never going to have to raise rates again was insane to start.
But see, that's really interesting, because it tells you he drank the Kool-Aid. It tells you all these people, they're in this little echo chamber. If they had been listening to my podcast, for example, or looking at your tweets, which, by the way, she's at Carol with a C, J.S. Roth, then they would have perhaps clued in to what all of us were seeing, which was that inflation was getting embedded in the economy. It was not transitory. Transitory, my you know what. I was so sick of hearing that one. And we were going to have a problem. But they couldn't accept it. It wasn't the party line. They didn't want to hear it. It's like having the answer, right? Already. They're solving. They're not bothering to come up with the answer. They know the answer. Don't worry about inflation.
Trish.
This is going to be a soft landing. And so they figured 1.5%, 1%. Why not? We'll lock that in for 10 years, you morons.
Yeah, they thought there was going to be no consequences. And I think one of the missteps, before we kind of get back to the story of what happened, is that because inflation in terms of spending is separated from asset inflation, I think that the world looks at them differently when they shouldn't. The reality is we had tons of inflation, tons of consequences from all of this policy, but it was in the asset side, which Wall Street loved. It was in home prices. It was in the stock market. We inflated that really, really well. It just didn't spill over until that stimulus was then directed towards the average individual. And then all of the supply constraints that we had that were made worse by the Biden administration, then it started hitting what is, kind of a traditional measure of inflation, things like the CPI. and so on and so forth. So I think that, again, they were benefiting from it, and they were going, oh, there's no consequences from our actions, not realizing there were grave consequences. They were just the ones benefiting from
No,
it.
for sure, for sure.
So,
And I mean, 1, 2, 3 stimulus checks. Come on. I said by the second one in August of 2020, look, you can't do both. You can't have both the federal government handing out checks, all while Jerome Powell is printing money in ways that historically we'd never seen. I mean, they increased the money supply at such an exponential rate. So,
but it was insane. Let's go back to, the first thing they did in March of 2020 was they supported Wall Street, like before anything else, as if that was like the Main Street economy. And Wall Street wasn't getting shut down, by the way. It was the small businesses on Main Street that were getting shut down.
yes.
But it was supposed to be an emergency measure. The NASDAQ hit an all-time high on like June 5th.
I know.
So if you have all-time highs in the NASDAQ and the stock market, what emergency is it that you're solving for?
It was incredible. I remember thinking, and one of my friends who's a professional money manager said, it's getting weird when my mother-in-law is calling me from Arizona saying, can I buy this, 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 and this? It was like people couldn't go to Vegas, so they were suddenly buying stocks. I mean, you could see it all unfolding. And I'm like, what's wrong with me? Because I don't buy this. I'm sorry. Like, this is scary, scary, scary. It reminded me of the year 2000. Then I was reminded of 2005, 2006, 2007, as the Fed just kept printing money. So we're in a bad spot now in that all of this paper out there, all those treasuries, well, they're not worth as much. And if you're not willing to hold it, if you have to mark to market like a bank does, then you're going to have to take a discount, which is why the Fed opened that window. And I'd argue, and a lot of people don't like me saying this, but I'm like, oh, if they hadn't opened that window, well, Carol, you say it. What would we have been looking at if on Sunday night, I was annoyed it took them so long on Sunday. If they had not opened that window on Sunday night and said to every bank in America, hey, if you have a problem, come borrow money from us, what would we have been looking at this week?
Okay, so before we even address that, let's discuss the fact that they should have done this before there was a panic. There would have been no panic. It would have been very quiet and we would have gone on our merry way. But the fact is that politicians are always reactive and they don't address any problems until they become massive.
Well, do you think in this case, Biden was worried because of all the heat that you think back to 2008, all the heat that the administration took for the quote bailout? Was he just really, really worried that people were going to see it that way?
Biden has any idea what's going on about anything. So I don't think he was involved in this. I don't think he knows what day it is.
Okay. All right. So this is Janet and Jerome.
I don't think this was a Biden decision. Let's just be clear about that. So here is the nuance. And I know you and I have both taken a lot of heat for this, but this was not a bank bailout. This was not saving Silicon Valley Bank. This was not saying we're going to make the shareholders whole. They showed the management the door. Frankly, a lot of the management had been selling shares in the weeks up to this happening. They should claw that back. Like those people, there should be consequences.
By the way, those were automated things, because I agree with you. Somebody should have turned it off, but those were automated sales that were going through.
Yeah. So I think that, whether they were automated or not, they still don't deserve to be able to keep them. But at any rate, what was happening was just backstopping the depositors. And in terms of it being a bailout, we still don't know yet how much FDIC insurance is even needed because the FDIC is trying to sell the various assets right now. Not real successfully, by the way. They've had a couple of broken auctions here, but there's going to be a fairly small hole that needs to be plugged. Yes, the taxpayer is going to pay, not directly, but in terms of perhaps higher fees in the bank or lower interest or whatnot. But the consequence, if that didn't happen, in my opinion, and I think we're on a similar page, is mass contagion throughout the banking system that would have set everything on fire. Everybody would have been pulling their money. It would have been mass pandemonium, and forget about recession. Like, we could have been like
Well, that would have been the
barreling
Great
toward the
Depression. I mean,
depression.
do you remember the
Yeah.
scene in It's a Wonderful Life? I'll have to pull that
Yes.
and play it for people.
Yeah.
I actually showed it to my kids over the weekend because they're like, what are you talking about? And mom wouldn't stop talking about bank runs all weekend. But I was like, look, this is what happens. And this is why confidence is so critical, because no, a bank doesn't always have all the money on hand, right? They're investing it in this, that, and the other. And in the case of many of these banks, they were putting it into treasuries. Well, the treasuries they can't get for 10 years unless they want to sell them at the discount. And if they sell them at the discount,
Right.
they don't have enough money. Boom, it goes
And
on.
And on top of that, to just layer on the Fed's role here. So the Fed, when they raised rates, rates and bonds trade in an inverse. So that's what caused the current market value of those bonds to go down. If they held them to maturity, it would have been fine. But on a market basis, that went down.
Okay, really quick. I'm going to jump in. We're going to do a little bond math here. Just a quick little lesson for anybody who's wondering, like, why is it that when yields are going up, the price is going down? Explain that phenomenon.
Yeah, because, basically, if you could go out and buy the same duration or a shorter duration bond and get a higher yield, there's not going to be as much demand for that bond in the current market, and they don't have to pay the face value until the 10 years are up. So it's just basic.
Well, and typically, yeah. And typically what you would see is that you would get a higher yield to hold that money for 10 years as an investor, because you're taking on more risk. And of course, we won't get into the inverted yield curve stuff that we're dealing with now.
No, but it does bring the point, and this is the other accelerant that happened here, is the other side of the Fed equation. When the Fed raised rates and people have their money sitting in deposit accounts, and they're getting 1 or 2% on their money, but they could park it in a very short-term treasury and get like 5%. Mm-hmm. Depositors like, well, I'm just going to do that. So they started pulling some of their money. The economy is going a little bit sideways, so they might need more money for working capital. So the other side of this is, as the Fed was raising rates, there were more people who pulled their deposits than the bank had projected based on a normal bank baseline. So the fact that there were depositors that needed that money, and that money was tied up for the 10 years, except for if they wanted to take a loss, that was that mismatch. So, it's the Fed backdrop of playing God with the economy that created the scenario, and then the management's boneheadedness of not, appropriately assessing risk, going to something they thought was low risk, but again, not thinking about duration.
And don't even get me started, because, one of their risk management officers over in the UK seemed to be more interested in making sure they were ESG compliant. We're going to have to do another conversation on that one of these days, Carol. But, she was obsessed with making sure they had all their LGBTQ stuff and that they had a mental health blog. And I'm like, wait. Was anybody looking at the portfolio to think maybe there was a way to hedge just the possibility you might get some inflation in the future? So, the Fed did what it had to do. So theoretically, the system's been saved, and yet we got a market that's tanking today. Why?
So I believe you're referring to some issues with another bank, which is Credit Suisse. And, these things are all related, going back to, easy money and, the overall kind of wonkiness of the financial system. Or I should say, I guess jankiness is even better than wonky in this particular case. But the reality is, Credit Suisse has been a mess for a long time. My guess is that, up until this point in time, people weren't that concerned about it. But now that everybody's attention is laser focused back on the banks, because we have this tenuous situation. And by the way, we have these banks that have been within the crypto arena as well, that have also had major issues. So there are kind of these different bastions of issues that now, look, we have another issue.
But Credit Suisse is different. And I think in some ways, actually, maybe Credit Suisse worries me a little bit more, because then I start to say, well, what do other balance sheets look like? I certainly don't want to see a repeat of 2008. And I hope that those liquidity stress tests are strong enough. I mean, Credit Suisse says they are. They said they're not having any issue with liquidity.
They always say that.
Yeah. Well, I guess they have to
We
say
have
that,
an
right?
issue,
They don't want to look like they're causing a bank run.
Has there ever been a collapse where somebody has come out and, people are worried about it, and the day or two before I went, yeah, boy, we're really in big trouble here. I'm not feeling real good. We're gonna throw a Hail Mary, but it's about 50-50. Yeah. They're always like, oh, don't worry, we're liquid, we're great every single time. So
so you don't buy it, and you're smart not to. There was a CNBC commentator who did buy it 2 weeks before SVB went down. Jim Cramer was saying this is a great buy, blah, blah, blah. So look, I think it's really important to kind of cut through the noise, figure out what's going on. Credit Suisse says they're fine. Carol Roth says they're not. Why not? And can this spread?
So I have not spent enough time digging into Credit Suisse to say they are or they aren't, other than just following them for a long time to say this is a bank that I wouldn't have touched with a 10-foot pole. By the way, there are a couple of others, Deutsche Bank being one of them. And I know it's one of the big banks here, but just based on their own lending practices and history of corrupt behavior, Wells Fargo. And that's just my own personal opinion. I don't like any of those banks.
Okay.
Not to say that I think that Wells necessarily has an issue. I just think they have other issues, if you know what I mean. But, Credit Suisse and Deutsche Bank are two that, have had all kinds of exposure to all kinds of weird products, which again is different than what we were talking about with Silicon Valley Bank, with this treasury being locked up. And not to make mistakes like, the other folks do who go on and say, oh yeah, everything's great, everything's bad. I haven't done enough research to be able to specifically say how bad of a thing this is going to be.
I mean, I think a lot of people were hopeful. So the Saudis have a big stake in Credit Suisse, but they're limited. They can't take on more than a 10% stake, and they're already at 9.99 something. And so there was some hope that maybe the main shareholder there from Saudi Arabia would be able to help them out here by, I don't know, taking on more ownership or doing a stock buyback. That's not the case. I guess my question to you would be, how much of this is psychological at this point? I mean, we know Credit Suisse was having problems before any of this other stuff. And it's not entirely related in terms of sentiment, perhaps, but I think that these are different reasons for having stress at these institutions. Should we be worried about other institutions, other investment banks, which we know do take on more risk than the regionals?
Yeah. So I always say over what time frame, because, are we talking about this week? Are we talking about this month? Are we talking about for the next couple of years? I mean, the entire financial system has a ton of issues. They've taken a lot of risk. There are consequences, as we have seen, from this period of, zero interest rates, easy money, risky behavior. And that is going to come to roost, not to mention the fact that the Fed has been destroying the purchasing power of the dollar, the government spending like drunken sailors, there being a huge mismatch in the actions of the Fed and the government. So everybody's sort of rowing in their own direction. I am extremely concerned mid to long term about the financial system. I think we are headed towards a new financial world order. I don't have a crystal ball to say if that's going to be 6 months, a year, or 15 years.
I was thinking 50 years. So you're way ahead of me. I certainly hope not in the next 6 months or even in the 15 years. But I think about my children and their future and, what generations are going to be dealing with. And you've got a lot of competition out there on a lot of fronts. And if we can't keep our house in order, right? That's what we're supposed to do. We abandoned the gold standard. I get it. We had to because there wasn't enough gold. And by the way, there was a complete, willingness. If you think back to what Nixon had to do and the abandonment of Bretton Woods, there was really no choice. But if we don't have
there was a choice. They just didn't want to take the they didn't want to make the hard decision, right? They didn't want, and that's the problem. The politicians never want to make the hard decisions. And that's what puts us in they'll just kick it
Do
to
you think we're
somebody
going
else.
to
But
inflate our way out of
eventually,
debt? Here's one for you. I was talking to a China expert. Gordon Chang actually was on the show recently. And I said, do you think we will inflate our way out of debt? Because I look at all this inflation and I don't think it's necessarily scripted or anybody has a grand plan. Sometimes I wish the government actually did. But all this inflation, I mean, China, they're sitting there with all these bonds themselves saying, well, gee, this isn't worth what we thought it was going to be worth. And if we have to hang on to this stuff for 10 years, it's definitely not going to be worth what we thought, especially if the dollar keeps, getting decimated in value.
Yeah, I mean, it's also the question of dollar being decimated against what? Because the dollar has been strong against other currencies, which creates a whole host of other potential issues, but it is weak against your life. It's weak against your groceries and your rent and all those things. My big concern here, Trish, is I think this is going to be a cover story and a push for a central bank digital currency, a CBDC. I think that the Fed is going to use this and say, well, we can't have bank runs and you'll have more security if we're in control. And then they will marry that, with social credit, with all of these other issues that they're pushing. And that's really where I'm concerned about where we're going. And by the way, this isn't like a complete theory here. They're testing a CBDC right now with major financial institutions. And the G7 came out with a list of principles for retail CBDC. So you don't do that if that's completely off the table.
But does that still get you away from the central bank's power? Because I think these guys are all on a power trip. They think they're God. They don't understand the value of the actual markets.
It consolidates more power, it gives them the ultimate power, and it takes away. I mean, think about it. So imagine you had $1, and I'll just use a piece of paper as $1. Imagine there was a chip in it, and when you went to spend it, the chip beeped and it said, "Oh, I'm sorry, like you've eaten too much ice cream, Carol, this week," or Trish, you've filled up your gas tank too many times. We can't let you do that. Oh, by the way, you said something nasty on Twitter again. And this is what they can do. They can marry that and they can control it, because all of that, they will control it. They will know everything that you do, and they can program it to be able to change it at their whim. In China, they've actually tested having it expire. So if you don't spend it, at these certain locations or within a certain time, it just goes poof. So this is, talk about the nationalization of banking. This is the nationalization of all money and freedom. And that's my big concern out of all of this.
It's a something to watch for sure. I guess I misunderstood. I was thinking maybe there was a chance we could replace the Fed with a computer, which I think Milton Friedman once famously suggested. And I think we'd be a lot better off than having these individuals.
The K% rule. I mean, this is what I've been saying all along, is you don't want to just abolish the Fed. You want to abolish the Fed's powers. I would say we've printed so much money over the last, however many years, that we probably don't need to increase the money supply to keep up with productivity at any point in time in the near future. But if you ever did, you could tie that to something like growth in GDP and just make that a formula and just, it's done. But yeah, the likelihood that anybody gives up that level of power is nil. And I think the opposite is happening with these shifts in the financial world order. There's going to be more panic and more attempts to jockey for control and to be on top. And I think that's what we're seeing here in every single thing coming at us.
This crypto dollar thing, this where the Fed knows exactly what you're doing. And I saw the example in China. It was extremely spooky. Yeah. And the Fed is testing, right? It's digital dollar. They've made that clear. I think there's been a little bit of a push, right? Because you don't want China to get ahead of you in that sphere. But if you do have a digital dollar, Carol, gosh, you're right. The government then knows every single thing you spend money on. And they want to know. I mean, for goodness sakes, Janet Yellen campaigned to get into your bank account if you had so much as $600 coming in and out on any given year.
Janet Yellen, who's wrong about everything. Somebody pulled up, I think it was maybe Hedgeye pulled up something from 6 years ago, a Reuters article that said that Janet Yellen said, we're not going to see another financial crisis in our lifetime. And it's like, okay, there was going to be no inflation. Inflation was transitory. We're going after the billionaires. Like, how is this person who has had two of the most powerful positions in the world, playing God with the economy and doesn't know anything.
I know. I actually, I'm very disturbed by that because you assume they're smart. They went to the right schools. They got all those degrees. I'm like, you must know what you're doing, but they don't.
They don't know. And that's the problem with central planning is even if they were smart, you can't have a handful of people just playing God because human nature kicks in, incentives kick in. It just never has worked anytime, anywhere in history, which is why going back to something that looks more like a free market is where we want to be. But for the people saying, well, you just said that you were in favor of a bailout and that wasn't free market. The banking system isn't free market. So we have to work within the parameters that we have today, right now, as we try to march towards, a better future.
It makes sense. And here's to free market capitalism. And occasionally when those idiots at the central banks do really, really stupid things like leaving rates too long for way too long, too low, too long. And then it's coupled with more stupid things from the federal government, giving out all this stimulus, multiple rounds. Well, we find ourselves having to do what's necessary in a given moment. But it should be a lesson to all of us and to the system that we need improvements. Again, we're talking with Carol Roth. Her Twitter handle is Carol with a C, JS Roth. Just quickly before I let you go, you got a book coming out saying you will own nothing. What does that mean?
So, I mean, this is the outgrowth of all of the research that I have been doing. You will own nothing is a phrase that came out of the World Economic Forum. They had put out a article and then a video on their top predictions for 2030. Their number one prediction was you will own nothing. And people are like, oh, that's a conspiracy theory. And, I looked into it. It's sitting right there and you're going, okay, well, I know property rights are a good thing, and I know that property rights create wealth. Why are people who are very well connected championing the end of property rights? And when I look at our late stage financial empire 80 years in and compare it to what happened in London and Britain and in the Dutch empires before and see where things are going, we do have a situation where the elite see this and they are jockeying for control. So whether it is social credit, whether it is business social credit through ESG, whether it is CBDCs, whether it is what they're doing with college, whether it is trying to grab the $84.4 trillion in wealth that's going to turn over via inheritances in the next 23 years, there are forces coming at us from all directions, big tech as well, that are trying to take your life and at the best case scenario, rent it back to you, but really preserving their wealth and making sure you own nothing. And I want to preserve the American dream. I want you to own everything. So lay out exactly what's happening. And then, of course, give you the battle plan.
You're here. No, I mean, we need to own everything. Yeah. We need to protect ourselves. That independence, that freedom, that's all we've got. And so whatever you need to do to put yourself on the right financial path, and there's lots of ways to do it, you got to make sure that you're taking those steps because you're right. Otherwise, you could find yourself up a creek without a paddle, as they say. Carol Roth, it has been wonderful to talk with you. Thank you for all your insights.
No, my pleasure. It's great to be reconnected. And it's always nice to be able to have these high level conversations, but also be able to break them down in a way with somebody who understands them so well so that people who aren't within the financial inner circle can feel included, can understand what's going on, and hopefully be empowered to make better decisions. Because I know people are really nervous out there.
Yeah, no, I get it. It makes sense. Thank you again, Carol.
All right. Hope to see you soon. Bye.
My thanks again to Carol. If I were going to open a bank account for Fluffy, he deserves one, right? Look at how cute that face is. If I were going to open a bank account for Fluffy, where would I do it today? I'm going to be perfectly honest. It wouldn't be one of these regionals. It just wouldn't. As much as I love them, and I love to be able to go into a bank and know that they know my name and have that kind of rapport and not have to call someone at a call center halfway across the world in order to get a question answered. I love regional banks. I grew up going to one. I remember the Portsmouth Savings Bank in New Hampshire, and I used to have a little passport savings book. Remember those? Where we used to have all our money, and I would work in the summer as a waitress or as a bus girl or as a sailing instructor. That was my first job, actually, when I was just 12. They paid me a whole $25 a week. I'm pretty convinced it was child labor, but they got away with it under the guise of work experience. Anyway, it was a good job. It was a lot of fun when I was outside. But my $25 a week I would take and I would put into this bank account. So I will miss that, right? I think we're all going to miss that. But if I had to open another account today for Fluffy or for anyone, I'd be going with one of the bigger ones, only because they are subject to a lot more regulation and a lot more scrutiny. And that's the tragedy of all this. I hope that we don't lose these regional banks, whatever has to happen. And I know that this has been discussed. We've got to think about instituting more regulation for the smaller guys too. I mean, and this is Trish Regan saying this, right? I am about as capitalist as you can get, but I do know that when it comes to people's money, you have to be extraordinarily careful. And when they put it in the bank, they want to be able to get it out. My grandmother, she never wanted to put money in the bank growing up because, well, she lived through the Depression and she knew what it was like if you couldn't get the money out of the bank. We can't live in a society like that. So if I were opening a bank account for Fluffy, as a vibrant and handsome as he is, it would probably be at one of the big guys. He's vibrant, he's handsome because I feed him Rough Greens every single day. roughgreens.com/Trish. It's a vitamin supplement specifically for dogs. It was created by Dr. Dennis Black, a naturopathic doctor who's got 2 big dogs. My guy's just little. So anybody, any small, medium, large, depending on the size of your dog, they can all benefit from this. It gives Fluffy all the probiotics, the digestive enzymes, the vitamins, all the healthy things that he needs to be smart and healthy and vibrant and hopefully to live a very long, exciting life. He means the world to me. I know if you have a dog, your dog probably means the world to you too. Send me a picture. If you're watching this on YouTube or on Rumble, would you just send a picture? I love looking at pictures. I try to answer a lot of the comments. If you haven't, make sure that you subscribe. I always forget to tell you to do that. So please do make sure you subscribe to the channel. But send me a picture. I love, love, love seeing these. It just makes me smile. So if you love your dog like I love mine, you probably want him to be eating healthy and eating well. So go over to roughgreens.com/Trish. You can sign up for your free Jumpstart trial bag. All you have to do is cover shipping. It can be at your house in a couple of days. And tell me if you see a difference. I think you will. And you're going to feel good knowing that your dog is getting what your dog needs. All right, we're going to continue watching this entire situation. This really is, in some ways, quite eerie in that it reminds me of 2008 all over again. It's not 2008. I'll be clear on that, only because I really was on the front lines of that one, and that was pretty darn scary. This, I think, because we've seen that movie before, is a little bit more manageable, but it's important for you to understand it and to know what's going on. I've been talking about bonds in recent shows up until, yesterday and today, because bond yields were looking pretty darn attractive. And I'm like, who the heck needs the headache of the equity market when you can be investing in a treasury, say 6 months, and get 5% on it? That's pretty darn good, right? Well, that's all changed. Today, we see bond prices going up, yields going down. Everybody's looking for safety. They want security. So the bond investment, I wouldn't necessarily rush out and buy that today. I might wait a little while. We got that debt ceiling coming up. I'm sure we'll hear a little politics along the way with everybody promising that they can somehow default on the debt. That'll scare everybody. Then interest rates will go back up. So you might want to wait till then. But again, I'm not your financial advisor. I have to say that for all kinds of reasons. I'm not. And you should always seek your own counsel. But I would just say this. Be careful right now. Make sure you're diversified. Look for opportunities, but be very, very cautious about them, because we are not out of the woods just yet. Thanks so much for listening. Give it a thumbs up. Make sure you subscribe. Make sure you hit the bell, and I'll see you tomorrow.